welcome to the Mortgage Broker Builder Show, the CEO1440 Show, where we talk about all things mortgage, real estate, and a whole bunch of other just ancillary topics. And this week, we've got some pretty exciting guests. Paul's been on here before talking about AI. Jamie, I've known for years. He's one of the best in the non-QM space, oversees the sales team there at American Heritage. And today we're going to talk about non-QM, American Heritage, tips, some tactics just that loan officers can do across the board to do more business. But I just wanted to welcome these guys. There's about 400 years of mortgage experience here. I'll let you guys determine who has all of the years. I've got 25. Paul's got a few. Jamie's got a bunch. So with that kind of being said, how are you guys doing today? What's new in the non-QM world?
What's up? How are you, John? Well, thank you for having me.
For sure.
Again.
Jamie?
Good morning, gents, and thanks for having me on for the first time.
Right. We appreciate it. So I wanted to just kind of, we'll jump in here kind of quick. Yeah, I have this philosophy now that I try to give people as much value without taking a lot of their time. So we can kind of skip past the pleasantries, but we've all been doing this whole thing now well long enough to, right? Like I got started when Bill Clinton and Monica were in office. Yeah,
we've got like a century of mortgage
experience. So
here.
We've probably seen a little bit of everything, and just kind of want to step back and talk about what you guys are doing today, the non-QM space, and how loan officers can utilize it across the board. And what else is really interesting, Paul, how long have you been with American Heritage now?
So I've been with American Heritage for about a month and a half. I come from the conventional conforming world. I've done a lot of business. I spent 20 years just, Quicken, UWM, wholesale. And so most of my business was done on the conventional side. Even when I had my own brokerage, we didn't do a lot of non-QM, I'll be honest. So yeah, this is a new world for me.
And Jamie oversees people across the country. He's got AEs all over the place. American Heritage is an up and coming company. A lot of people ask me, hey, I've got this non-QM deal. Where should I send it? And I always say, have you looked at American Heritage? And people are constantly blown away. So if the first time you're hearing about American Heritage is right now, that's both good and bad. Good for you in that they do some really cool things that not a lot of your competition knows about. So good there. Probably bad for them that, not everybody knows about them. They're not a household name, but they've got some really cool programs. I think we're going to get into that a little bit here today. But Paul, so you've been there now a month and a half. What is like the number one thing that your takeaway for somebody that maybe has more of a traditional background like yourself? What's been the biggest kind of aha moment that you've seen since being over there?
There's a lot of business that I left on the table when I was a broker by not doing these deals. These deals, there's a market for them. They're seasoned. There's they're being packaged. They're being done the right way. And I was very surprised to see how organized the non-QM space actually is. That was big for me.
That's interesting. I think Paul brings up a great point. Successful career himself, predominantly like many people in the A world, particularly, since 2009 or 10. And so people don't always even understand what today's non-QM borrower really looks like. And on average, it's about a 740 FICO, around 70 LTV, with about 2/3 purchase and about 2/3 of the borrower self-employed. So, if you just think of those aspects, John, it's really a successful self-employed borrower, probably with a really good accountant who can afford the next level house, but, has some really good tax deductions and doesn't qualify on paper. The credit risk is solid. And as a result, the paper performs very well. So, you made a comment earlier, good and bad. It's like all things in life. Many originators weren't happy to see rates go from 2.5% to 7.5%. But what it did was it opened people's eyes to new streams of revenue. To Paul's point, you didn't necessarily need a non-QM loan in 2019 with all the IRLAs and streamlines flying around.
Right.
There's a great pool of borrowers here that are really underserved.
Well, I think too, as I look at this product, and you and I met, I'd say probably going on 2 years now, since, we've become acquaintances and now I think friends and probably mentors. And I had no idea really what was actually out there. And I closed my first non-QM loan, did a fix and flip loan back in 2016. Right. So have been dabbled in it, did them here or there, but always thought it was this fringe one-off thing that was, for the guy that had a bankruptcy yesterday and, some crazy thing. It was going back to the associates days of, 1999, 13%, 5 points. Like, it's not that. This is the way that I see it. There is a whole world today. More and more people after COVID are now self-employed. A lot of gig workers, a lot of people not doing the traditional W-2, 9 to 5, sit in an office, collect a paycheck, put your money in a 401k, retire with a pension. Like, that world's going away. And Fannie Mae and Freddie Mac have not kept up. So there's a whole subworld out there. And I don't know, you probably have better stats, but what percentage of the market right now is non-QM as far as like, is it 5%? Is it 10? And what do your experts, I know you talk to Wall Street all the time and they know where things are going well before we do, because they're the ones offering the product. What are their anticipations of what this market becomes, let's say, over the next 12 to 18 months?
Yeah, that's a great question. And this year has been a very good year for non-QM, but as we came into this year, which we don't have stats for yet, non-QM was roughly 5% of the overall mortgage market in terms of funded production. Now, remember, it didn't exist 10 years ago after the crash of 08, 09. So, in terms of today, or, as we came into this year, it was around 5%, John. In terms of what it should be or could be, we don't know what we don't know. We know that, for example, in the year 2006, roughly 42% of the market was non-agency paper, and clearly that was too much, right? So there's a safe point where you keep those healthy credit metrics that we discussed a few minutes ago, but still let people take advantage of alternative financing. The rating agency folks, the bond folks, et cetera, peg it around maybe 15% as an estimate of overall mortgage volume could be non-QM safely. So right there, that's a big runway in front of us to go from current volume levels to where it safely could be. I would dare to say it's probably one of the bigger runways available right now in mortgages. There's not a ton of refis out there. There's a ton of home equity built up in terms of HELOCs and HE loans, but those are only so big in loans and loan size, and there's only so many revenue dollars to go around. And purchases are always good, but inventory and maybe participation in DAP, so forth, might drive some of that business. So if you just think of a runway in mortgages, if you want to go originate more loans today, non-QM really is pretty wide open.
I want to kind of step back. I've done so far on this call, I've done one of my biggest pet peeves. I know exactly what non-QM is. I've been doing this for 27 years. And often we talk about these, right? Like, we're old mortgage people. So we talk in acronyms and expect everyone else to know. Can we just get kind of a definition of who is the non-QM borrower today? What do they look like? What problems do they have? And let's just call non-QM. Anybody that's out there listening, you could just think of non-QM as non-cookie cutter. So you've got this small box that is Fannie Mae and Freddie Mac that only takes certain things. Everything outside of that is non-QM. So if you're doing a $2 million loan, you're non-QM. If you're doing a bank statement loan, you're non-QM. So it's anything that doesn't fit inside of that small government, this is Fannie Mae and Freddie Mac are government institutions. Anything that doesn't fit inside of that small box is non-QM. Can you just kind of tell me like what the non-QM, like what are you guys seeing? What does your non-QM borrower look like?
Sure. Well, I gave you some general credit matrix stats there in terms of, average FICO 740, LTV around 70, a lot of purchase business. So again, you think of that, a lot of non-QM borrowers are bank statement borrowers. So they're using bank statements to qualify. I always joke when we do presentations, we'll know these borrowers. They're in our hometowns. They're successful plumbers or contractors with multiple trucks that have been in business for years. They're very profitable. I always joke, everybody drives a nice car in the family, the kids play lacrosse, and they want to buy the next house with the pool. And reality is they can afford it, but they have a really good accountant. So, that right there, the successful self-employed individual is really a good chunk of non-QM. Non-QM is really a lot of the same business that our average broker sees every day. It just lives along those edges of that Fannie Freddie box you described, John, just along the fringes. So a great example, again, was the bank statement borrower where it's an income issue. We see folks where they may have substantial assets and they use a certain draw. And based on that draw and the tax returns, they don't qualify. We have ways we can do asset depletion and use that as an income stream. So there's an income rub sometimes. Sometimes it's a property issue. For example, we do a lot with non-mortgable condos and condotels. Go to any major city in the U.S., Boston's in my backyard. Go Sox, by the way. And no offense to the Yankees who are in the World Series. And so, you can go right down Boylston and see high-end residences above a Ritz-Carlton or a Mandarin Hotel. Those are great condos, great sale prices, great loan amounts, but the unit's non-warrantable due to commercial influence and commercial square footage. Well, we love that loan in the non-QM world. No offense to Fannie's condo guidelines, but that's a great loan size. The borrower is well qualified. The property's in a great area. You've got comps. I don't mind if 62% of the square footage is commercial, which happens to be a high-end hotel and a Starbucks. I'm okay with that.
And John, just to interrupt, I can't tell you how many of those deals I turned down in the A-paper world. Right? I turned down those deals left and right. I was like, I don't have a place for you. I don't have a place for this. I don't have a place for this. And having a conduit like American Heritage in the non-QM world is valuable.
I want to share an interesting story. My brother Josh is here. He helps us with podcasts and do a bunch of stuff. I'm looking at him on the screen. He was purchasing a home and came to me and I said, program doesn't exist. It's not even real. Guys, blowing smoke up your ass. He closed on a house on a program that was very real. And me, right, with my big ego and being here for 25 years and a 4-digit NMLS, I knew everything there was to know about loans. And, he goes and closes on a house and I didn't even know that the program existed. So, and this happens, if it can happen to me, it can happen, across the board. And I also know that people get caught up in the Fannie Mae, Freddie Mac world where you've got this small box. I'm pretty sure that in your guys' situation, I don't know the exact number, but a large percentage of your deals actually close with one or more exceptions, which the exception is kind of the norm in that you're finding good deals from a common sense approach versus finding good deals to fit into the square box that it has to fit into. Can you just talk about like exceptions, how that works inside of your world? I know every non-QM company is going to look at it a little bit differently, but I think you guys are more liberal maybe and more common sense approach. And you were talking about the condos, but there are other examples there of things that you could cite?
Yeah. I think roughly 38 to 42% of our monthly production is some kind of exception to our guidelines. We do think that we make very good common sense exceptions. The loans perform very well. So, knock on wood, I'll use hardwood. That seems to be working well. We're lucky enough. We have some real advantages, John, in the exception world. We're partially owned by one of the larger funds that securitizes loans in the background. So that helps. We write our own guidelines and make exceptions to them when we see fit. Our head of operations, or TPO, has been in the business many, many years, and it's just extremely seasoned in non-agency lending. Actually, you mentioned the associates earlier. She goes back to the associates. So used to making credit decisions, very comfortable doing so. So we have advantages there.
Hey, if you're here, it's because you understand that the world is changing at an alarming rate, and you understand that big data is going to dominate as we move forward. Either you're going to use it to grow your market share or somebody's going to use it against you to grow theirs. If you want to dig a little bit deeper here, take a look at your own business, figure out and identify some key constraints, maybe some things that you could do a little bit differently to grow a little faster. Here's what I can tell you. After 27 years of doing this, helping well over 1,000 loan officers earn hundreds of millions of dollars in commissions, there are a couple of key constraints inside of your business. I don't know what they are right now. I just know that they exist. So if you're curious about this, let's get on a strategy call. Take 20, 30 minutes. You will walk away with one or two actionable items that you can do to do more business as you move forward. There'll be a link someplace here on the page. I look forward to personally meeting you.
And the process internally is very clean. I mean, somebody like Paul, pre-submission, if there's, hey, John, you call Paul and Paul him off by, 3 FICO points or a couple months of reserves or something. Here's my compensating factors. Paul can submit the exception pre-submission, get it approved, file flies right through. Something comes up during the process, as we all know, it sometimes does in our business. Our account managers are very, very adept at that point. They have the file live. They'll ask for an exception. So, we're lucky in that we have the credit width from a lender perspective to do so. Lucky that we have the in-house personnel that's comfortable making those exceptions, and we've got a pretty streamlined process.
And I was just going to add that that's another thing that really surprised me is the process at American Heritage is really, really buttoned up. It's not to say that you don't know what's happening with the file. You put a file in, it's going through underwriting properly. I'm really impressed by the process that we
Yeah,
have.
and I've worked with quite a few. I have, different broker partners across the country that work with a whole lot of, companies. And as far as like the portals go, the ability to submit loans, somebody on the back end actually understanding what's happening. A lot of these smaller non-QM, I call them shops, companies, they're still running stuff off of Excel spreadsheets. It's got Susie in the back office that Susie does things. There's not a lot of automation processes. And there's a really hard, any companies goes through like that mom and pop shop to like the big, there's a lot of growth and it's hard to make that leap. And I consistently see, right. And I've worked with companies and stuff, closed hundreds of loans with American Heritage and have seen the progression where you guys keep getting better. And just out of curiosity, like what is about your average turn time? I know we launched a call center here in Michigan. I think last month we were looking at like 21 days from submission to closing, like maybe even something a little bit quicker than that, which is uncommon.
Sure. I think in general, we run under 30 days this year from submission to funding, which, we do think is probably one of the better averages in non-QM. We do attribute a lot of that to the portal that you mentioned. We hear from our customers regularly, particularly the folks in the back shops, that it's probably the closest thing they've seen to an AP portal in terms of functionality. And then, to your point, John, we're lucky to have a group working in Michigan, including Paul. And last month on their production, the average loan came in from registration, went to clear to close in, 23 days or something. We're happy with that. When you can see a two handle, as we call it, some of those loans were in and out in, 11 days or 12 days. We're lucky in that regard.
And and some of it may even be slowed down just because there's a purchase contract that's closing in 40 days. You don't have to get it done fast, right? So like 23 days on a 40 day, even if it's 30 days, you're still well ahead of the game there. Something we haven't talked about, and Jamie, I know we've had a lot of conversations about different things. If I was a loan officer, and I know you're a sales guy at heart, and Paul's been out now, calling on loan officers, but there's some different programs. I know one weekend you started like calling people in Canada about foreign national loans, or like you're always out doing things. You've got a whole, going after divorces. You've got a lot of like sales techniques for somebody that's out there to figure out how to make your products kind of a niche product. How do you leverage that inside of your community? And I know, Paul, you're having a lot of conversations. What are you guys seeing that loan officers are doing, brokers are doing to capitalize on these niche products? And what do you think they could do more of?
I think that there's a lot that loan officers can do. I think these products, there's a lack of knowledge in the marketplace for these products, and what they can do is market these products. It's an education of the marketplace, in my opinion. You've got to educate your audience as to the fact that these loans are available. There are investors out there. There are doctors out there there are self-employed people. There are foreign nationals. There are humans out there that need to get financing, that can get financing, that aren't being talked to.
Yeah. I think Paul hits the nail on the head where, there's some really, I guess for lack of a better term, niche products available, and they're non-traditional. And so that's awesome, right? But you probably need to maybe fish in non-traditional ponds to find those borrowers. And so, we always try to help our partners do that. If you ever go to our webpage, ahlendtpo.com, we have a series we call Originate More. And, it might be, hey, here's how you might originate more foreign national loans. Here's how you might originate more condo-tel loans, et cetera. So I think it starts with, if I'm an LO, John, I always enjoy our talks because we get into all kinds of sales strategies. But, if I'm an LO, I'm going to look at my backyard and assess that and see where there might be non-traditional items. So Boston's my backyard. I know in Boston, there's a bunch of non-worthwhile condos already referenced. I know in Cambridge, for example, Cambridge, Mass, there's a bunch of just small condos, 2, 3, 4 unit condos that are non-warrantable, that are great properties with like med students renting them. So if I was an LO and it doesn't cost me much to do this, I'm going to brush up my knowledge on non-warrantable condo offerings, talk to a couple good partners, somebody like Paul, and I'm just going to hit the streets that day. And I'm just going to go to all those little boutique realtors. And by the way, these are pretty nice loan sizes. And I'm just going to knock on the door and I'm literally going to say, what are you doing with your non-warrantable condos? Like, what are you doing with that condo for sale? I'm going to call the listing agent. When I mentioned the Mandarin on Boylston, I'm going to call the listing agent on that condo. I'm going to say, are you having trouble financing this thing? Because I have products that specialize in this.
And these are things that a lot of these loan officers can be doing especially right now, they have time.
Yeah. And if you think about the market, right? So let's say if of 100 home buyers, 100 homes that are going to sell, let's say 25 of those are going to sell cash. Somebody's just going to come in and buy a quarter of them are going cash. And let's say that, so that leaves 75%, 15% of those could end up, with an investor doing a DSCR loan. We haven't talked about that. A foreign national, somebody coming in from someplace else to buy it, ITIN loans. You've got different bridge loan products for every client that can do that. Heck, you guys even have a standalone bridge product where you can still close with your Fannie Mae, Freddie Mac first and do a bridge loan, right? Which is crazy. So there's so many options and real estate agents market this thing to one person. But if I've got like you use that thing with the college students renting, I would be promoting that with the DSCR loan on the back end. Hey, would you like to purchase this home in the name of an LLC and not use any of your income to qualify? Use the income that the property's generating. We just closed Jimmy down the street and he did it. You can too, right? So like you're going to market and get to that other niche. So there's so many opportunities out there. And it is, right? This is an area that can 3X pretty easily.
Yes, absolutely. Because the reality is many people still don't even understand or know what non-QM is. We do presentations, Paul and I on a, weekly basis with brokers. And, we hear often like, what is a DSCR loan? How do I fill out the application? How do I figure the qualifying ratios? And these are questions from folks that are 10, 15, 20 years in the business, very successful. It's not that they don't understand mortgages, but they've never had to use these products before. And so, there's just so much of available out there. As a loan officer, you don't have to spend a ton of money to try to source this stuff, right? You look for those targets you spoke about and you marry that product, with the target and, there's your calls.
And think about this. If you are going in, let's say you're trying to get after a real estate office, go in with, I understand you already deal with so-and-so, and they've done a great job for you. I was looking in, MMI, model match, whatever it was. I was looking at the product mix of them, and it doesn't look like they do any of this. Keep sending your vanilla stuff there. All I ask, when you get an oddball client, send it over. Give me a shot. Let's see what we can do. Right?
And real estate agents love these deals. They love investors. They love talking to people that have, opportunities, that people are working on stuff. And then they are a great conduit to get some of this business.
And you have something to talk about other than being fast and closing, bringing great rates, right? Because everybody's fast and has great rates today. So if that's all you have, you actually don't have anything. So that's really cool. Well, let's talk about bridge loans. I know that's been something that you guys have been leaning into a bunch. I mentioned it before about a standalone bridge that I don't know of anyone else that offers it, or at least not the way you do. So are you guys seeing a lot of traction with that? How's that kind of working out for you? I get emails from you, so I see the flyers.
Yeah, I'm happy to report it. It's working out well. It's working out well in terms of conversation pieces. It's working out well. We've gotten plenty of loans in. It's working out well for our partners, the loan officer, the loan originator, because they're using it to Paul's point, to really get in the doors with realtors. It's funny, if you ever dealt with a realtor, if they've been in the business for a while, somewhere in their career, they lost a transaction that probably could have been saved by a bridge loan. And to your point, John, they're not readily available. And ever since then, they've chased the product like the white whale, even if they don't even need it. So it's a great door opener for loan originators and realtors. So we do offer bridge in a couple solutions. Again, this is for primary residences. That's the unique part. We can do a standalone. So what we're going to do is on a departure residence, and the spirit of the loan is I own a house for a few years. I've got substantial equity. I need the equity to buy the new house or put the money down towards the new house. and or I may not qualify to do both of those things. And of course, in this day and age, most sellers don't want to take an offer with contingencies. So what we'll do is on a standalone bridge, on your departure residence, house has to be on the market. We'll go up to 70 LTV. We'll give you cash out towards the purchase of the new house. It's a 12-month term. What's nice is it's an interest-only term. The payments are deferred during the length of that term. So while you're moving and so forth, there's no payment pressure and there's no qualifying ratios on that loan. So it's really a great way to use your current equity to help you secure the next house. And in that case, again, to your point, it's standalone, John. So if your borrower qualifies for a Fannie or Freddie loan or whatever after the case, there you go. Awesome. Everybody's happy and our broker made their customer happy and we smile then. In the case of a dual situation where they need help on securing financing for the new home, the acquisition property, we will do the 2-loan solution. So again, on that bridge portion, we'll now go to 75 in the departure residence, give the cash out, same terms. So it's a 12-month term, interest only, payments deferred, no cash flow paying to the customer. What's nice is on the acquisition property, when we underwrite that, we will take the other payment out of the debt ratio. So they can really qualify, full qualifying power up to 90 LTV. And there you go. It's a great door opener for us. It's a great door opener for our partners who are realtors. And yeah, it's going well. Thank you.
And
yeah,
correct me if I'm wrong, but they can do that in conjunction with a bank statement loan or a 1099 loan, or it doesn't have to, right? When I talk to real estate agents and people that have been out there, the big hang up on bridge loans is that I've tried in the past, the person didn't qualify because they didn't make enough money to carry all of these payments. And so those problems are being solved today with a lot of these non-QM solutions with bridge loans are taking that borrower from, what would have been a no over to a yes, or in the past used to be a no today or not yet until they could sell their other house. And that limitations went away. As we're talking about real estate agents, you guys recently rolled something out that I'm pretty certain is first to the market. I haven't talked about it yet because it's kind of cool, but we have the whole NAR thing, right? The whole world, like real estate agents were going to be dead. And I'm surprised there's even one left anymore after all the fanfare that came out with that, right? They weren't going to make it past. Well, they're still out there. I still get emails. I still see them posting on TikTok. So they made it. But you guys just did something really neat. At least I think it's neat, that solves a problem for a lot of consumers, agents. And you want to talk about that a little bit?
Yeah.
Paul.
I was going to say, I worked with a lot of real estate agents in my life. When I had my brokerage, most of our business came from real estate agents. And, when this NAR thing came out, like you said, it was like, oh my God, the world's going to end. What are we going to do? And the world keeps going on and it moves on and it adapts and nothing ever gets blown up. This is just the way that we are. We adapt. And we are, I think, first to market for doing this. And it's, again, another conversation piece for our partners. It gives them more ammunition. We're here to support our partners at the end of the day. And this is another way that I think we're doing it.
And Jamie, do you want to explain the program? Well, I want to get into numbers, right? Like you could buy a house with 25% down and then finance up to 3% in a realtor fee. And it goes into the loan amount, but your LTV is not impacted. And right, you can pay your realtor commissions through this thing. I'm trying not to I've gotten the flyer, I got the email and I read it and I was like, yes, that's freaking sweet. I knew it was coming. And I think it's even a little bit better than what we had talked about before, as far as what you guys were going to do. So tell me a little bit, just what you guys actually did.
Yeah. So, it's funny. You and I haven't spoke since we actually rolled it out. So as you know, John, we've always had this great thing called stacking. Or LTV stacking. And that's where we allow the broker to stack or the borrower to stack up to 3 points on top of their loan. And in the past, they could use those 3 points for either broker fee and or a lender discount. So in the past, hey, it's a $500,000 purchase, 80 LTV primary bank statement, just vanilla deal. Broker wants to make 2 points in the deal, which is $8,000. What we were saying is, and still are, is rather than have that borrower bring $8,000 to the table, along with the $100,000 down payment, along with escrows, impounds, U-Hauls, new couches, they can finance your broker fee. We raise the loan size to 408. That in itself is unique. Even though your LTV is now 81.6, your pricing stayed at the 80 LTV bucket. So that's our stacking feature that we still have. And again, it's up to 3 points. What we've added now is, in light of the NAR ruling, we're still seeing how that shakes out and how people are going to play it. But we now will let you stack up to, within those 3 points, you could include your buyer agent fee. So theoretically, on that same loan, if for whatever reason, it was worked out through the contract, hey, seller, we're going to have our own buyer agent. And then the borrower went into the buyer agent and negotiated a 2% buyer agent fee. So again, you got a $500,000 purchase. Buyer agent fees, 2% or $10,000. That $10,000 can be added to the loan amount. So that $400,000 loan amount can become $410,000. You can pay the buyer agent fee now. And it just helps the borrower have more options at the end of the day. We don't know how much they'll use it or not. But Paul hit the nail on the head. We're trying to add value to our partners. And with the original stacking feature, or the way we originally used it, our brokers were able to stand out from their competition by offering these options to their borrower. Like, you can bring the $8,000 to the closing if you'd like, Mr. Borrower or Mrs. Borrower, but if you can also have this option. Bank of America doesn't have that. Wells Fargo doesn't have that. JP doesn't have that. So our partners had that advantage. Now they can also go into realtor shops and say, hey, if your buyers are structuring things this way, we've got this cool feature.
And just some cool things that I've seen on there is, if you do have somebody, the lending world works on the premise of risk equals rate. So the more money you put down, the lower LTV, the better rates you get. A lot of times the difference between a 75 LTV and an 80 LTV may have been 3 or 4 points. It was literally cheaper for the client. If you as a broker wanted to make, let's say 2 points, it was cheaper for the client to go at 75 and stack 2 points than it was to actually do the 80, because if you still with compensation to compensation. And so it's really crazy to think about that it was actually cheaper to get a 75 LTV stacking fees than it would have. The rates and everything else got better. So it was like kind of just this weird, I don't know, like an arbitrage where you could go in and do this. And then on the realtor side, being able to have that in your back pocket. Let's say you're looking at properties, and this property over here, the seller's willing to pay 2%. Well, this property over here, for whatever reason, the seller's not. And so buyers today are being boxed out of that property if they don't have the down payment and if they don't have all the pieces. Well, this opens it up. Like for that buyer, it opens that property up. So it gives you as a buyer and you as a loan officer and you as a broker a wider net, could go out there and capture clients with unique situations. It's one of the coolest things that you offer.
Agreed. So go back to your question, John. If you're a loan officer, you're trying to drum up business, you're trying to grow your book, you're trying to originate more loans. We do private label marketing, so if you call Paul right now, he'll get you a flyer as a loan officer with this feature to give to your realtors. I'm knocking on doors of realtors, and like, you really have something different that your competition doesn't have. It costs them nothing to do that.
Yeah, and it's a problem. I mean, it's a problem for every agent out there right now today. They have to now have these conversations with their clients. They never had to in the past. And so you're solving a problem. Well, let me ask you guys just a couple of quick questions here. I guess I'll give this to Paul because he's recently owned a brokerage, has been in the space. So Paul, this is a question for you. If you were a brand new mortgage banker starting out today, or a brand new broker, you just opened your brokerage shop, you got limited funds, you can't go out and spend, $25,000 a month to drive leads. You have to go out there and find business quickly. What would be 1 or 2 things that you would put all of your, where would you focus your time?
I would definitely lean on my sphere of influence, obviously. That'd be numero uno. But I would start being active, whatever that means, in any way, shape, or form, whether that means going to real estate offices. I'd work on my network. I would really, really start working on networking as much as I possibly could, whatever that means. Everybody should know that I'm doing mortgages. I own a mortgage company. I do what I do, how I do it, what we're into, what products we're into. I would definitely attack the market from that standpoint. But I would also make sure that I had all the products available to me that I can possibly have as a broker. And I think that goes back to like the American Heritage thing where, I wouldn't overlook these products like I did before. So I'd be having some different conversations than I had in the past for sure.
So just cast a really wide net. You want to have more options.
I would look for things that are inexpensive that will get my name out there, right? Like things that are inexpensive that'll get my name out there. I can go on Facebook and get in front of how many people I have in my Facebook. I can get in front of my LinkedIn, my Instagram. I those people, like, a lot of times we'll make a post and they'll say, oh, 50 people saw it. Well, 50 people saw your post. If for me to get 50 people in a room would be pretty hard, but 50 people saw that last post, even if it's 100 or 200. I think digital is big. But I also think there's nothing that's going to replace going out in the streets and actually making yourself known in your backyard, because you want to own your backyard when you have a business like that.
Great advice. Hey, Jamie, now you pitch or you do lots of presentations with lots of brokers across the country on a weekly basis. I know you provide a ton of support for your AEs. So you're in there doing this, like you're in the mix, maybe more so than anyone else. What is the one single thing, if you had to point out, that you see of all these people that you present to, what is the biggest struggle that kind of consistently you see brokers having out there?
Hey, that's a good question. At the end of the day, John, it's sales. And, I think in anything in sales, no matter what you sell, you're just trying to find a way to stand out, and be different. Everybody's getting sold something every day. Across every industry in the country, right? Like we're all being sold burgers and cars and clothes and insurance from multiple brands every day. And so, it's no different as an AE or a loan officer. They're looking to, I think really stand out somehow. Everybody wants to originate more. They want to build their book of business. And they want to try to do it in a sustainable fashion. So they don't have to, maybe they actually get some repeat or referral business each month. And it's not always recreating yourself.
What I wouldn't do is I wouldn't complain about rates. I wouldn't complain about what's going on in the world. I would just go out there and work. I wouldn't focus my energy on, oh man, this deal didn't work, and then spend all the time just working in your pipeline. You gotta get out there and not complain about what's going on.
Intentionally or unintentionally, everything we do is building a personal brand, right? And your brand speaks volumes. If you're complaining online, your brand is the complaining guy. If you're talking about people's problems and the potential solutions you have, that's your brand. So it's literally every single thing we're doing is creating a brand, and we are being sold from the second we wake up. I started getting sold today within about 30 seconds of my alarm going off. I had a kid that didn't want to get out of bed. They were trying to sell me on why they didn't need to get up. I had people trying to sell me on what was for lunch, how fast to drive, what songs to listen to. I'm literally, you were being sold nonstop all day, every day. And so how do you attract those eyeballs? Well, I think that this is great. If people have questions about non-QM, they want to talk about, what things you have there at American Heritage. I know American, they can go and check you out online. I would suggest you reach out to Paul directly. I know that at AHL, TPO, there's a pricer on there. People can go out and actually price out their loans. They can look at it. They don't need a login or anything like that. You guys post a bunch of stuff on social media, but where's the best place? If somebody's got questions, they want to understand more about these programs, these products, how you can potentially help, where should they go?
They can call me directly. Call my cell phone, 586-242-2468. Email me, Paul, Apostolakis, APOSTOLAKIS, .com, at AHLLend.com. If you could put those up on the screen, Mr. Jerkovich, Josh, that'd be great.
We'll get them in some show notes. Now, this is great.
Yeah.
So I want to encourage anybody that's out there listening to this. If you have questions, you haven't missed the boat yet on non-QM. Most people have no idea. This is a market that I personally think we'll see double. More and more people will continue to gravitate towards this. More and more people are moving to being gig workers, to doing those kind of things. And if I had to pick between the two, I would tell you, you're going to be far better off writing off every single thing that you can, and maybe potentially paying a little bit higher mortgage interest rate and doing a bank statement loan or something along those lines than you would ever paying the IRS. So and I think more and more people are getting that. Accountants, this non-QM space is going to continue to grow. And if you're a broker and you don't understand it, reach out to these guys. Paul's been there a month and a half. He may not have every answer, but I can tell you this, in working with him, he has all the support he needs on the back end to be able to figure it out. He's not like the Lone Ranger. He's got Tonto over there, right? He's got his sidekick, Batman and Robin. They've got a ton of resources. Their portal's really good on the back end. Their pricing is great. So if you got questions, reach out to these guys. They're definitely happy to help. That's all I got to say.
Awesome. Thank you, John, for having us on the show, man. We really appreciate what you're doing. I think it's you lead from the front, and we appreciate it.
If brokers do more, if everybody makes a little bit more money, the mortgage industry is a little bit happier place, right? Like across the board, that's good.
Yep.
After doing this for 27 years, you see the ups and the downs, right? We've been through a downtime, but I see that we're coming out of it. And I like to see people do well. We've got, a whole bunch of stuff on my end. I post all the time. I've got tons of different coaching options. If you want to sit down with me and have a conversation about how you can grow your business through non-QM, through anything, everybody's business out there across the entire world, doesn't matter your business, you have a key constraint. If your key constraint is inside of the mortgage space, I've got 27 years doing this. I've literally worked with well over 1,000 loan officers, helped them earn, probably hundreds of millions of dollars of commission. I can definitely help you figure out what your key constraint is inside of the mortgage business. And I bet if you don't know anything about AHL and non-QM and those products, I bet one of your key constraints is that. And how do we free that up and help you make more money? So I appreciate it, guys. We'll get some show notes out. Thank you for your time. And everybody reach out to Paul and the guys over at AHL. Awesome. Thank you.
If you're still here and you're watching this, you're probably getting something from our content. If so, maybe or I'm sure someone else that could also benefit. So if you could do us a solid, forward this, share it with your friends, other people that are like-minded that want help with simple solutions to grow their business. And if you want to do a little bit of a deeper dive someplace on here, there is a place to schedule a call with us to talk about your business and how we can grow it together. Look forward to hearing from you. Again, thank you for being here. Please do share.